Volatility in the crypto market continues as consumers digest the downfall of FTX. But how should investors view the embattled space long term? Retirement Planners of America CEO and a senior advisor, Ken Moraif, joins us now to discuss. Ken, it's good to see you. As we look at now the fallout from this situation, obviously a lot of people poured into crypto, particularly during the pandemic. Then they maybe step back already a little bit as we saw prices go down. Now that this has happened, how should regular investors be thinking about crypto?
Well, our space is people who are over 50, who are retired or retiring soon. So I'm going to talk to those people. There's two lessons learned here. One is, we have an investment philosophy for our clients where we say that we only want to take as much risk as is appropriate to accomplish our financial goals. So if we determine by working with a client that the appropriate amount of the return that they need to satisfy their standard of living during their retirement, let's just say is 5%, then we will stay away from Bitcoin and cryptocurrency altogether. There is no reason at all why we should have that in our portfolio. So the first lesson learned from all of this for people who are about to retire or who are retired is take only as much risk as is appropriate to accomplish your goals. Determine what your goals are. What rate of return do you need to support the lifestyle that you want? And then construct a portfolio that contains an investment mix, a diversified portfolio that gives you the highest chance of achieving that rate of return. We call it your hurdle rate, HURDLE. So the hurdle rate is the rate of return you need to support your lifestyle. So if your hurdle rate is 5%, then that would dictate a different investment portfolio than if your hurdle rate is 8%. Okay, so and if it's 8%, we have to talk. But the point being that how much risk you take in the construction of your portfolio, you shouldn't be taking too much risk. So for our people, we never ventured into the Bitcoin world or the cryptocurrency world or any of that. We talked about it, we laughed about it. A lot of times people said, man, we're missing out. And I'm like, no, you're not. That's not a space you want to be in.
And so it sounds like enough people are asking about it for you to have to do your own kind of research and put together a calculated, not just response, but a calculated way forward for their portfolio and when they can really capitalize on any type of investment that they do make. So if not crypto, where else are they deciding to kind of look into an investment opportunity?
So when we're looking, again, it goes back to the individual client and how much risk do we need to take to accomplish their goals. So generally speaking, we use, very traditional, we don't go into, put options or derivatives or any kind of super sophisticated, and we'll call it risky stuff. We go with the, traditional plain vanilla stocks and bonds, diversified portfolios. We also believe that you should have a strategic overlay. And again, I'm talking about people who are in our demographic, where we believe that you don't just buy and hold. You don't just buy stuff, invest, and then rebalance it and keep it forever. We believe you should also sell. We have a strategy we call invest and protect. And again, we think growth is important, but we think that protection of principal is even more important. And so we have a strategy that addresses that. And in fact, we have been out of all stocks and all bonds since April of this year because our strategy told us it was time to protect our clients. So, the construction of your portfolio needs to be determined by how much risk is appropriate for you. And then in other words, what's in it, what percentage of stocks, what percentage of bonds, how aggressive you're going to be. But in all cases, regardless of what your hurdle rate is and how much risk is appropriate for you, there are times when cash is king, and we think that now is one of those.
So Ken, I'm just doing some real-time calculations. So you're not in stocks, not in bonds, and then where are you allocated?
Currently, we are in the money market fund, and our best friend in the whole world is the Federal Reserve. We love those guys. What they're doing right now is they're raising interest rates. And every time they do, interest rates in the money market fund goes up. And when they raise interest rates, as we've seen, stocks and bonds go down and the money market fund doesn't. So we're happily waiting out the storm. We're not going to be out forever. Our strategy also does have metrics to tell us when it's time to buy. but we're not seeing that right now.